Well, I think this is as good a time as any to shift gears a bit. Why don't we start talking valuation? When we last covered S&P, I was not totally convinced by the valuation, and since then the stock has pretty much been flat. So really, the big question now is whether the business itself has improved and what the growth prospects look like going forward, and whether they've kind of grown into their multiple a bit. And we actually just talked recently about how the overall market feels more expensive than both of us expected. And so maybe it's time to look at company valuations through a different lens. And the S&P 500 is at about 30 times earnings, and that's a little cheaper than S&P Global. But if you look at the forward PE, both the market and S&P are about 24 to 25 times. And I think we'd both agree S&P Global is a far better business than maybe the average company in the S&P 500, but it's also a little bit of a straw man argument if you think the S&P 500 itself is dramatically overvalued. And yeah, I don't know. I mean, you're paying a similar multiple for a much higher quality, but I don't know. It's an interesting place to start the discussion. You tell me how you think of it, Daniel.
Well, just like you, I've just have hard times accepting that 30 times earnings is supposed to be the new normal. I mean, we've seen plenty of great companies over the past few years that haven't really delivered strong returns. I mean, we talked about some of the businesses on the show. We had Amazon, for example, and honestly, S&P is one of them. Most of the time, it just comes down to valuation. They were just a bit too expensive and basically priced for perfection. That's always a term I like to use, because if you're priced for perfection, it's basically the opposite of what we look for, which is asymmetry in the companies that we try to find. And when that's the case, even if the business keeps performing well, it's often just not enough to make investors happy. And add in a little uncertainty or perceived disruption like all the AI noise, and that just hits nearly every sector. And then you can get some pretty sharp pullbacks. I mean, we've covered quite a few companies on the show that have seen that, but there are even more that we haven't yet covered. I mean, just look at Constellation Software, which is down almost 40% from its all-time highs, and it's still one of the best run companies in the world. The valuation eventually just caught up with it. So yeah, when I started digging into S&P Global, I was pretty confident actually that it looked like a good deal at current prices. I mean, it's trading at a forward free cash flow yield of 4%, which is pretty high. Surprisingly though, it's not even, it's actually slightly below the average for S&P Global over the last 10 years. So yeah, after running the numbers in my model, I gotta admit, it's not as cheap as I hope. I'm modeling revenue growth of around 7.5% per year, which lines up with S&P's long-term average and reflects steady mid to high single-digit growth across basically all the divisions they have. The ratings and market intelligence businesses are both set to grow around 7 to 8%, commodity insights and mobility around 6 to 7%. And yes, mobility will be spun off, but I still included it here. And the indexes business, roughly 8%. So yeah, top line growth isn't really something that gets you excited. It's not spectacular, but it's not bad either. It's fine with the company the size of S&P and the quality it has. What's more interesting, and I mentioned it before, for me personally, is the margin expansion story. I mean, it's totally reasonable to assume that operating margins can climb from about 40% today to roughly 50% by the end of the decade. And that will come as the company finishes kind of digesting the IHS merger and continues to benefit from just operating leverage and really starts capturing efficiency gains from, for example, integrating AI across the different business segments. And those improvements should flow right to the net income margins as well. And I'm assuming, as we talked about before, that the share count will keep declining by about 1.5% per year. You could make a case for 2%. I want to be a bit conservative, but I think that's pretty much in line with what we have seen historically. And if you have all these assumptions and then you use an 8% discount rate and maybe a 10% margin of safety, which isn't that large either, this would give you a fair value of around $440 per share. That's roughly 10% below where the stock is currently trading today. And well, the most important variable, if you look at the model, is really just the exit multiple. I use an exit multiple of about 27 times, which is not really high, but it's not that low too. It's pretty much in line with the historical averages. And I don't know, I think it's also a fair bit lower than its trailing average, which has been close to 35 times. And if you compare it to the broader market, then 27 times is more or less in line with the S&P 500's current valuation. If you use an exit multiple of 35, then suddenly the price you would get is about 570. So what I want to say with this is whether S&P will be a good investment or not mostly depends on how the market will value the company. And that's just not that great of a setup or not the type of opportunity I look for.
Yeah, typically we want the story to speak for itself, where, for example, you could assume even pessimistically, looking at maybe the growth decelerating or some contraction in the multiple, you can still plausibly underwrite perhaps a double-digit annual return. And as an example of that, when I looked at Ulta earlier this year, I saw a company that had this incredible track record of reinvesting into itself while the stock had hit this period of short-term turbulence. And the returns from incremental new store openings were just so good that, especially as they were beginning to expand internationally, I could feel pretty confident that, hey, even coming off a rocky year, Ulta's earnings could not only keep growing steadily, but could really bounce back dramatically, potentially. And then you layer over very aggressive share repurchase programs, driving earnings per share as well. And then the fact that the stock was trading at a 10-year low in PE terms, I mean, you could underwrite pretty satisfactory returns by just betting on the durability of the core business and very attractive returns if you were to expect some mean reversion off of a pretty low PE multiple. So we were thinking about how exit multiples factored in, but more in the sense that we knew we were buying in at a relatively low multiple, and there was good reason to believe that PE expansion could be a tailwind, or at least not a headwind going forward. So it was almost like you're looking at it, you're saying, all right, in the base case, we're thinking we're going to get an 8 to 10% return or higher, and then there's this like call option built in where we think that once we get through this period of fear around the stock, there's pretty good reason to think there'll be much further upside if you get some normalization in how the market is essentially valuing the company. And that investment ended up working out very well for us. And so in this case, though, it sounds like S&P's core business will continue to do fine, but it's not enough. We're not obviously getting in at a valuation multiple that we have a margin of safety. And over really the long term, it is true that the entry multiple matters less, but I think it's okay to be a little greedy here too. I mean, S&P is not going anywhere. I don't think we're going to miss out on the chance to ever invest in it. And if it doesn't meet our expected return requirements at current prices, I'm happy to kind of put it at maybe the very top of our watch list and wait till we can put our cash to work when there's a more significant price dislocation in our favor, right? Nobody is forcing us to swing today. And we say that a lot on the show, but I think that's really how you have to think about investing. I mean, if you're looking at a different company every week, most of the time the companies are going to be about fairly valued. And then it's a question of, okay, generally, from a kind of qualitative perspective, is this a business we want to own? And then thinking about, okay, what is the kind of price point where we would start to get very excited about entering it relative to the opportunities that we have elsewhere? Because you always have to consider when you're putting cash into one company, you're not putting it into Alphabet or Reddit or Uber or Nike or Ulta or everything else in the portfolio. So you have to constantly be weighing against the other opportunities in your portfolio and in the market more generally.
Well, we just added 2 positions in the recent weeks to our portfolio, which were Transdime and Copart. As you just said, there's always an opportunity cost to buy or establish a new position. And then we have just looked at so many companies that I find that building out our watch list is actually one of the big competitive advantages that we have, looking at one company each week. And then we now understand how this business works. We know it's a fantastic business, but we also know that there are a lot of cyclical businesses in S&P. And if the market sells off at a certain time, it probably hits S&P even harder than some other companies. So as you said, it's a company that's high up on our watch list. But for now, I think we're holding off owning S&P. We're not yet adding it to the portfolio. And maybe at a later price point, if the market is rewarding our patience, basically. But who knows, maybe next week you have a company that we can immediately integrate or buy into or for our portfolio. So how about you give us the hints for the next episode so we can try to figure out which company that might be?